All right, so sorry it took me so long to create this video. A lot of things came up, but also I really want you guys to focus on that first video, which is the high probability video. That is the greatest video I ever created on algo trading. All of my current bots are built on that, and we've relabeled it level one of probability trading. We're gonna have two other levels to actually improve what we found from level one, but that is, I'm telling you, go back and watch the video 1,000 times, as many times as possible until you understand it. Go look at the Algo Trading 101 video. If you, I'm 101 doc on my link in bio. If you don't understand Python, it gives you all the resources to learn how to use Python for data analysis, which will be helpful in creating that program for your strategy. If you don't know your odds, you're fucking cooked. Anyway, that's besides the point. But please watch that video again. You have to watch the video again thousand times, because you can't go into level two, you can't go into level three until you finish the level one video, because after that video, level two will show you how to expand upon it. Now we have 7 probability bots, we have 10 more to launch, and a lot of them are not going to pass level two testing. And then level three is going to be a statistical model added to our bots to trade live and to regulate the bots live. So it's going to cut losers faster, and any of the winners that are made, if it finds that they have a high probability setup, it's going to add more contracts into a winning trade. So that means the losers will be cut faster, the winners will be expanded upon with that statistical model added into those bots. Super game changer. Can't wait to share level two and three just to show you how to do that. All right. But now let me go back to what I promised you guys. I promised you guys I'm going to show you guys how to do future testing, because I already said testing is key. Talked about back testing already. Now it's time to show you future testing. Now, future testing, the correct term for future testing is actually forward testing, but I am me. I'm not listening to nobody else. I'm saying future testing. That's me. I don't care what anybody says. Argue with tomorrow. Anyway, let's get into it. We're going to be using the Monte Carlo method, and I found IBM explained the Monte Carlo method perfectly. I don't think anybody else explains it any better than this description that I found here. All right. The Monte Carlo method, the Monte Carlo simulation is a type of computational algorithm that uses repeated random sampling to obtain the likelihood of a range of results of occurring. All right, mouthful, but I like this second one here, also known as the Monte Carlo method or a multiple probability simulator. Um, Monte Carlo simulation is a mathematical technique that is used to estimate the possible outcomes of an uncertain event. That's essentially what we're doing. So what we're basically going to be doing is taking historical data to create future paths, potential future paths. No, we're not trying to figure out what's going to happen in the future. We do not know, but we're going to be using past price data to create as many future paths as possible. In this case, we're going to be doing 1,000. And then we're going to see how will our strategy fare under each one of those 1,000 future paths. And then we're going to display that data in a histogram because it's 1,000 returns. The best way to actually display multiple data points, especially return data points, is using a histogram, because then you see on the histogram where most of the returns were. Were they profitable or were they unprofitable based on a start balance? So you're going to see once we get to the actual diagram, but that is essentially what we're doing. All right. Next. Now, next. All right, you need data. Gotta tell you, I use Data Bento for all my apps, but I also started using First Rate Data. They need to sponsor me because I keep recommending them, but they have great CSVs, clean data. I know in the past I mentioned use Yahoo Finance. Yahoo Finance is dirty data, and I don't even think it's free anymore. And they have like, I forgot what it was called again, but they're basically being blocked. They're blocking a lot of their APIs, which are unofficial APIs. So don't waste your time, especially even if you can do it. It's dirty data, so it's not even worth your time. Pay for some clean historical data. Use Data Bento or use First Rate Data. I believe the CSV here are $200, so it's 10 years and it's $200. So I got one. I got a few back in December. Got gold, silver, NQYM, and yes, I did get those. All right. Um, and I bought them one time. So I know it's $200, so $200 a pop. I'm not paying that again. So I bought them one time and I'm just running all my tests from those again. I'm not buying new ones. So you can do with that information as you want. If you want to stick to just NQ, just get NQ. If you have some friends, you guys want to like do this together, split up the cost and go in on this. All right. You don't need to do this by yourself and you don't need to buy a bunch of them. Again, I'm bought just those five because I'm testing a lot. and I'm not buying any ones. You're not getting me again. But anyway, that's besides the point. Let's get into the program. All right. Get your IDs ready. Get ready to write some code. All right. Now we're going to take the silver bullet strategy from the last video and we're going to forward test it and see how it does. So let's get started. So first we start with the imports, of course, and we're always going to use pandas and numpy. Data analysis 101. These are the two that you're always going to see. Matplotlib for displaying charts, date time, which is going to be important because we're dealing with CSVs with date time in it, and as well as knowing that silver bullet is very much based on time, specific times. Collections, we're going to be using warnings to get rid of errors because we all hate errors. Typing to get like different values, dictionary, optional, tuples, list, etc. PyTZ, this is a library for time zones. So we want to convert most of our time zones into EST, or you want to verify that they're in Eastern time zone. You don't have to pick whatever time zone that you're trading in, but this is a very important library, especially when working with data that you don't know. You want to verify that it's in the correct time zone because 3 p.m. Eastern is not the same as 3 p.m. Pacific or 3 p.m. Central. So you want to make sure all of that is correct. Then we will also import stats from the SciPy library as well too. All right. Now let's get into the strategy. So we're going to create the silver bullet strategy here. So pretty much simple. You know that it's based on specific timing. So the London kill zone, the New York AM, and the New York lunch. So we have to specify those times here. All right. The assets that we're going to be using, I'm going to be testing this on multiple different assets. Right now it's just NQ, but I could potentially use gold, ES, anything else. So I can actually just play around with this based on those values. So pick whichever one you want to use. If you want to just use NQ, just put NQ. And now the most important one, this is with working with that CSV. So this is how we're going to load it. Now, most CSVs, it depends on where you get it from. I think the ones that I'm using here, they had every piece of data, the open, high, low, and close, all in one column, the date, open, high, low, and close, all in one column. So I'm basically spending a lot of the syntax to split that up into different columns so that they all have their values specifically targeted to a single column as opposed to all being in one column. That's basically what I'm doing here. So based on the CSV you get, you could just play around with this, tinker around with this, and basically get that value. Don't worry, I'm going to also put a GitHub repo for this. However, again, if you're using a different data source, this won't work. So again, this is something you manually have to change based on whichever CSV type that you have, because it won't work. You just dump something in here, you're gonna have to just change it around, right? Now, identifying fair value gaps. So this is where we get the fair value gap. So a lot of it is going to be based on, again, we're using open, high, low, close data from the CSV. So fair value gaps are based on two different things you're going to need. You're going to need to know bullish and bearish fair value gaps. And the way you do that is it's a 3-candle pattern. So one candle, the first candle and the third candle have to be cannot overlap between the middle candle. The middle candle has to produce a gap that doesn't allow the first and third candle to overlap. So we have to specify that here. All right. So that's where we get the high and low values to get to the previous high and previous low. That way we can get the 3 candles. So then we just take the high values from the data set, plug them in for a previous high, and then, we minus it by 1 so that we can move down 1 more to get the previous one, or to get the next one, we add it. So then we just keep doing that. So it just keeps iterating over that. Same thing we do with the lows as well too, just so we can get all of the low values into previous low as well as next low. Right. This one, again, we're specifying how we're generating the gaps. So just like I explained, you got to make sure that the first and third candle don't overlap. That is what they're specifying here. And in a bullish setting, this is how you would generate a bullish FVG. And in a bearish setting, this is how you would generate a bearish FVG. Right. Now, liquidity, this is where we're going to have to get a little tricky, because you could use 2 CSVs just to be like one on a 1-hour time chart, and then the other one would be your entry one. So this one is, I think it's a 15-minute chart. But if you don't want to do that, you can kind of then consolidate most of the actual data to produce higher time frames. So like if I wanted to produce a 30-minute chart, I would take 2 candles from the 15-minute and then put those together, and then that is a 30-minute candle. You know what I mean? So that's essentially what we're doing. We're trying to identify liquidity levels based on higher time frame by consolidating 15-minute candles by 16 15-minute candles into one to identify a higher time frame. So that's like 15 times 16. Is that 15 and 16? So that's 240. So that's 240 minutes. What is that? Like the 4-hour chart, I believe. So that's essentially what we're doing there. We're trying to then plug that 4-hour into a lower time frame. So we're consolidating the 15-minute candles to get a 4-hour higher time frame liquidity level, which is just going to be highs and lows. All right. So the high is going to be the liquidity high. The low is going to be liquidity low. That's essentially what we're doing, right? Now the setup. I put a little ICT logic here. So it's going to be very, 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 very simple. So for right now, what we're doing is we're identifying one, the time frame. So we need the kill zones. That's the most important. We're only trading within the London kill zone, the New York AM, the New York lunch. That is the trading window. We're actually specifying that now here. And now we have to specify sell side and buy side liquidity, which again, like we did, we spoke about it up there. It's going to be what we specified for the 4-hour chart up here, and we'll plug it in down here. And the trading signals, again, you're going to have access to this, so you're going to be able to kind of follow it along. But it's always good to put notes in here just so you know what you're talking about, right? So the trading signals are very simple. Again, we're looking for a bullish FEG and a sell side sweep. So sell side is the low of the 4-hour. So we're looking for a low getting swept and then a bullish FEG back into the range. And we're doing the reverse for a bearish FEG. We're looking for a high to be swept and then a bearish FEG back into the range. All right. So that's why we're sweeping liquidity. Lows get swept for bullish FEGs, highs get swept into bearish FEGs. All right. So that's essentially what we're setting up here. And then we have to specify the sweeps too. Because then again, when it's sell side, which is the low, we're taking buys. When it's buy side, which is the highs, we're taking sells. So exactly what we were specifying above. And now we're just, again, specifying the trading logic because we already labeled them buy and sell based on, again, that same logic we talked about. So that is when you actually put, the profit and loss based on how we do, because then we're going to set some certain targets. So like we're doing a one-to-one relationship. So we're going to base our P&L based on a one-to-one entry. So we take a buy and then we take a one-to-one. If we make it, we win. We lose it, lose. All right, we lose one, we make one. All right, so that's how they're calculating the P&L here. And now we get into the Monte Carlo. So the Monte Carlo simulation, we're going to start off with $100,000. All right. Again, like I said, we're risking 1%. So it's 1-to-1. We're going to be doing 1,000 simulation. We're going to be testing for 1 year. So it's 252 trading days in a year. We're going to be adding a random seat. So just for like any random fluctuations. So we're doing 42. All right. And then we're preparing most of our data from there. So this is all the values that we just spoke above there that they're plugging into the actual class itself. Now we got to prepare the distribution. Remember, I told you we're going to get a distribution and we got to prepare a chart for that. So this is where we're going to take all of the wins and losses from the 1,000 simulations and piece it together in a histogram. All right. So that's what we're doing here. And we're going to simulate the trades here so that we can get the end of range. And you're going to see we're going to get a lot of a printout of the data that we're getting in. All right. And a lot of these, again, are just printouts of it. So when we go to the chart, this is a lot of the chart work that we're going to see because these are the important values that kind of help us determine how profitable the strategy is. And again, you're going to get this code, so don't worry about it too much. All right. And this is where we go back to the visualization I was talking about for the Monte Carlo simulation. And then we're going to plot the distribution chart, which I have already here. So you're going to see how it is. The VAR and CVAR are very important labels because these are specifying the highest 95 and the highest the highest 95 and the lowest 95. So it's actually saying how good can it get and how bad can it get. These are important values based on this strategy. So basically, based on 1,000 simulations, how good are the highest 95? How bad are the lowest 95% of those 1,000 simulations? So these are very important to let you know just risk based. How good can the strategy be? How bad can the strategy be? And you're gonna see it's gonna be very telling for the strategy. All right. So we go down from there. This is more of the chart work. We're just adding some labels, X and Y axis. Once we go to the chart, you're going to see what a lot of this is. And we're just going to be plotting both, which is going to be the simulation. You're going to see 1,000 actual simulations on a chart, and then you're going to see the distribution, which is the returns of these strategies, right? And this is how we just run the actual strategy itself. Again, we started with $1,000, a one-to-one risk to reward, 1,000 simulations for 1 year. The FVG size is what I was talking about above. We actually have to specify the FVG size. So the gap between the first and third candle, we're doing a 2. We're doing a 2 ticks. So 2 ticks is going to be the actual size of it. You can increase this as much as you want, play around with those values, and just generally just make sure you get it right. All right. And so we're going to then run the strategy here, again, with the same values too that we specified above. And we're now going to be able to see the 2 charts. All right. I also specify the CSV we're using. We're using the 15-minute one that I have. I have it on my computer, as well as with the asset we're using NQ. Remember, we had a list of assets above, so we just want to specify those there too. All right, so now how did we do? So what should I start with first? Let me start with the simulation first. So this is the simulation. So when you run this program, you're going to then get the stats here. So how did it do, generally speaking? I'm going to show you this, let you look at this first, and then we're going to see how it did, and then I'll tell you. All right. Okay. Now let's get to the actual chart. So this is the simulation. So these are all the 1,000. This is how all of the 1,000 paths fared out. All right. The white line in the middle is the starting balance of $100,000. And as you can see, the green line is the median value. The yellow line is the top 95 percentile. The red line is the lowest 95 percentile. So you can see based on the start value, in the median there, just let you know that this strategy flopped up. This strategy was horrible. It did not pass the future test. As you can see, the win rate was only 40%. The average win rate risk to reward was 1.25. So not a 1.1, but a 1.25. The average, the median return was minus 23.3%. Again, it lost. As you can see, even the highest 95% is now, as you can see, going towards the end, is going to basically cross below the 100,000 mark, letting you know that mostly all of the results were bad. All right. This is where we get into distribution. Now, distribution is going to show it a lot better. This is why I use distribution when you have a large amount of data, because it shows it a lot cleaner. So the start balance is here. This distribution is showing you where most of the returns were centralized. So this is the end value. So start balance was at 100K. As you can see, a heavy bulk of the end values were below 100K, meaning below the starting balance, meaning almost all of the simulations lost money. All right. A few of them, a very small few of them made more than 100K, but which means they profited. But a bulk of them, as you can see with the curve, the highest point of the curve and the centralized point of the curve was below the initial balance of 100K, meaning they always lost. The median value, the median return was $76,000, meaning like from the $100,000 that it started with, you lost, what is that, $24,000. And then the lowest 95, they went all the way down to $58,000. So almost half your account was blown with this strategy. That's something to really note. Actually, even further down, it actually went like if you go all the way down here, it actually crossed the 40%. So more than half your account was blown with the strategy. All right. This is a major red flag. Doesn't mean not to trade it. This is just something to keep in mind, something that you need to go back and review. Something needs to be fixed in the strategy in order to make it more profitable. But this is something to note. This is how you would future test a strategy and actually determine if it's good enough. Now, again, this code is going to be on my GitHub. I'm going to link it in the comments below. So please look over it, adjust this to whatever strategy you're using. And of course, you got to buy data. So I'm sorry, you got to buy data. Huddle up with some friends if you can't afford it. Change around how the CSV is used just to make sure it fits the CSV format that you're using. Where is it again? So yeah, right here. Make sure it changes that and plug and play and see how this works out for you. All right. But make sure you run it through this because this will open your eyes to why you're probably unprofitable. It's probably because it's just crap. This needs work. So it doesn't mean that strategy is crap. Again, the strategy is just as good as this trader. So the trader needs to go back and improve the strategy. So that's all that this is saying. So run your strategy through this and see what you find. Let me know in the comments below. Like, comment, and subscribe. See you guys later. Peace.